Hey Bulls and Bears, how is everybody doing? I hope well. Today is Sunday. It is July 9th, 2023. And thank you for joining in. It's been 2 days. I didn't put a report out on Saturday, so I am back. And we've got a lot of good stuff to get caught up on today. A lot of news. A couple personal things real quick. You might notice a different background with some different lights here. My 9-year-old daughter watched one of my videos and she said, "Dad, the background's all wrong, let me do it." So what you see back here, this is a 9-year-old idea here. Just rearrange some stuff, not really much new stuff. She did add some different lights there. So anyways, she'll watch this and she'll be proud of her background. So please take it easy on her. Alright, let's get into some news here. A lot happening financially, economically. Update with me. Actually ended up getting a car, and I'll talk about that more in a few days once the car actually arrives. It's very surprised. I think a lot of you will be surprised at where I ended up buying the car, and we'll talk about that when the car is here, so I can maybe put it in the video, and we'll talk about that maybe in a few days. Anyways, let's get into some information here. The stock market is on a losing streak, if I read this correctly. 3 weeks now in a row of negative territory for the major stock market indexes. Not all of the indexes had such a bad losing streak, but most of them did. So things are slowly turning. Remember, we also have the most corporate bankruptcies happening since 2010, and we're a little more than halfway through the year. In my opinion, the pace of these bankruptcies is going to pick back up in the second half of the year. I shouldn't say pick back up, will continue to worsen or to increase in numbers as the year end of the year comes forward. So we'll have to keep an eye on that. But we see that things are slowly turning. In our last report, was it our last report? We talked about how there's been a big surge in people looking for thrift shops, and the large opinion on that is that people are looking more to pawn items and get cash for the summer. And we have student loan payments resuming here very shortly, so people may be looking at that saying, "Hey, I better pawn some items to get some extra cash," which is not a good sign. A good friend of mine over in Florida runs a gold buying shop. He also sells gold coins and stuff like that. He says July 3rd was his busiest day of the year. Not one person came in to buy coins or gold or bullion, but they were selling, and it was a record day, the busiest day he's had since he's opened up shop over there in Florida. So another sign, combine that with what we're seeing with the U.S. consumers' shopping habits, and things are slowly turning. Remember, we're one of the only channels that told you that there wasn't going to be a crash. We called this more of a slow motion decline, or slow motion collapse is what I've referred to it in the past. Now pick your name, but the crash has not happened like many people predicted. Again, I was one of the only channels saying there wasn't going to be a crash. And that goes true with the housing market as well. Let's talk about the housing market. Big things are happening. But here's something interesting with mortgage rates. Mortgage rates really close to 7%. It depends on what day you check it. I'm looking at the Fed's numbers today, and we're at about 6.81. That's an average of the different types of mortgages. And I've got the chart pulled up down here. Mortgage rates now between 6.87% here in the past week or so. Even prior to the housing bubble going bust in 2008, late 2007, 2008, rates only got as high as 6.7%. So rates now are higher than what we saw before the last housing crash, and it was, many people would define that as a crash. It depends on your area. If you lived in Hobart, Indiana, you probably didn't see home prices crash because they didn't skyrocket in the years prior. But in many cities, home prices would be defined as a crash, what we saw back then. Now what's happened? What's different? Mortgage rates higher than they were back then. Home prices a lot higher than they were back then. So you please tell me what you think down below. What's causing the housing market to stay so elevated, for prices to remain so high? Unaffordability now is even worse than it was back then. right? So home prices are not just higher, but also the affordability is much worse than it was back then when you look at incomes and wages. I think a lot of it has to do with corporate buyers, cash buyers, and we see the home ownership rate has not recovered to where it was prior to the last bust. So that's one factor. But I'm not the expert on all this. A lot of you, I read your comments, you're very, very smart, and a lot of you have read, that I've read your comments, a lot of good information. So please let me know what you think down in comments about this housing market. Now on the housing market, let's go over to Wolf Street and wolfstreet.com and see what Wolf Richter has to say. Home prices drop year over year by the most since 2011. So when you look around, you're looking at prices. A lot of times it doesn't seem like prices are really coming down that much. They are down though year over year, which is pretty big considering how resilient the housing market has been. Ultra low inventory. Let's go ahead and put up a chart here from Wolf Street, and we see to the right side of the chart here we've got negative numbers. We look back, we did not see any negative numbers as far as year over year declines all the way back to, looks like, late 2012. So pretty significant there that we're seeing these year over year declines, and this is just the beginning. Speaking of higher mortgage rates and higher rates in general, we've got another rate hike likely in the cards for July, and we'll see if that holds true. The decision makers on these rates are in a very tough spot right now. If they don't raise the rates, they're going to be blamed for this high cost of living and for not fighting, quote, fighting enough against it. But if they do raise rates, they're going to be blamed for deteriorating the credit markets and people's ability to borrow money and actually afford the payments, right? So they're in a very tough spot. We'll see how they try to navigate this. There's still this talk out there of a soft landing. So far, it's been kind of a soft landing, even though we've had some bank failures. Obviously, corporate bankruptcies are increasing, the worst since 2010. So there's always something that leads the way or leads the charge, so to speak, and then the rest of the indicators follow. It could be individual bankruptcies led the charge, and then corporate bankruptcies followed. In this case, maybe corporate bankruptcies are going to be the one, the sector or the area, so to speak, that leads the charge or leads the way into this economic downturn, economic collapse. Next, let's talk about what our favorite Treasury Secretary Janet Yellen said. She said, quote, "Recession is not completely off the table." She said that, I believe, prior to her visit over to China. Did you guys see the video? She was over there shaking the hand of the leaders in China, bowing. She bowed like 2 or 3 times. Pretty strange. Anyways, Janet Yellen saying that, there's that word, the R word, that no one is supposed to talk about. Well, Janet Yellen's out there saying it. Not completely off the table. So it looks like they're trying to cover their own you-know-whats. And, because they know that this is going to happen. But if they're on record as saying it's not possible, that the economy's strong, and that's all that they're saying, then they're going to look pretty silly down the road when people just pull up the articles and videos, from what these people have been trying to tell us. Another thing, though, I wanted to add back regarding the housing market. Be very, very careful. A lot of the news that's coming out, they're trying to make the housing market seem stronger than it really is. I mean, a lot of people are surprised that home prices haven't dropped more considering the mortgage rates and the unaffordability. But articles are out there, a lot of them, trying to make the housing market look even stronger than it is. And it's really not that strong. It's just a delayed from now till the end of the year. You're going to see a huge difference in the housing market. Unless they do something crazy like cut rates. We see some sort of surprise event that changes the entire world where they have to cut rates again. But unless some surprise event pops up, the housing market's going to continue to decline. But here's an article I want to give an example here. Fortune. Housing market inventory is so tight that only one of the nation's 100 largest markets saw a home price decline in May. Only 1 out of 100 saw a home price decline in May. Sounds pretty strong, right? Like the market's strong. Well, that's only factoring in month-over-month numbers, right? So what Fortune did is they reported on April to May prices. Now the spring and the summer are typically the busiest buying season, or the buying times for the housing market. So of course prices usually always increase at those times. In this case, 99 out of 100 areas saw an increase. Just month over month though. Year over year, it's a different story. We showed you the chart earlier from Richter, Wolf Street, that prices are down year over year, right? So we can't just look at month over month numbers. If you look at these same month over month numbers going from November to December, you'll probably see 99 out of 100 areas with price drops, right? So be very careful on making purchases at this time, big purchases. I finally went out and bought a vehicle, and I've been waiting for prices to drop. Actually, I found such a good deal that I think I'll be okay even if prices drop further, and we'll talk about that again more in a few episodes here. U.S. bank lending falls last week, and that's some recent numbers here. Commercial and industrial loans, a key economic driver, fell by $7.9 billion to $2.7 trillion in the week ending June 28th. And here's the key from this article. The Fed has created an emergency backstop program so that the banks will not have to sell assets into the market if customers pull deposits in search of more attractive yields for their savings, right? So the Fed already has this emergency program in place for the banks in case the bank runs continues or people continue pulling their deposits out of these banks. Automobile prices, let's talk about this. Recent article here out of KCCI News. The average monthly payment for a new car is now higher than $700. We're not yet seeing new car prices fall. Used car prices have now fallen and are negative year over year, but not new cars. Very interesting, right? Over $700. Is this the first time it hit $700? Americans are now paying more than $700 a month on average for a new car, according to the financial website Bankrate. And this all started with the supply chain issues back in 2020, and another area, that people expected prices to come down or crash, and it has not happened. I think we're going to see further corrections as we go into the end of the year. More economic news here. Here's kind of a broader picture of what's happening now. The share of total net worth held by the top 1% is at an all-time high. Also, we've had 25 straight months of negative real wage growth. And when we say real wages, we're talking about wages versus the cost of living. And 3 straight quarters of negative net worth growth. For most people. Now the top 1%, they're still seeing some pretty strong growth regarding their wealth. Something else here that may be a leading indicator. This is out of the Telegraph. Mortgage borrowers race to take in lodgers as interest rates rise. Now this is out of across the pond, but it's going to be similar here, and I think it's already happening here. But more and more people are advertising for roommates, and even homeowners are looking for roommates. Likely a sign that people have overpaid for their homes and their house poor, and they need help making their mortgage payment. The number of advertisers for lodgers, or people renting rooms, at a website called Spare Room was nearly a fifth higher in the last 3 months as of June versus last year. So nearly 20% higher than it was. Not a huge spike, but just something else to keep an eye on here. Do you think that homeowners or people that bought in the last few years are approaching the point now where they're going to have to take on roommates, where they're going to have to sell? Do you think foreclosures are going to start increasing? And back to what we talked about earlier, mortgage rates now are higher than they were before housing bubble 1.0, so to speak, went bust. So what's your prediction on the housing market for the second half of the year? Please let me know down in comments. And we're going to wrap this one up today. Thanks everybody for being here. I really appreciate it. And we'll talk to you hopefully tomorrow. I'll be back with another report. Big love everybody. Keep stacking. Bye for now.